The window for institutional positioning around significant market shifts is closing.
You see, while retail sentiment is getting completely distracted by the headlines, the institutional flow data, well, it's revealing a totally different narrative. So in this analysis, we're going to break down the timeline, we're going to look at the drivers so you can understand the institutional positioning behind all this recent volatility. Okay, let's dive right in. Point number one, we're looking at a massive, and I mean quantifiable, liquidity event that happened just before the market-wide price drop.
So, what kind of scale are we talking about here? $4 billion. Now you have to understand, this isn't just random market noise. This is a huge volume of capital that was moved, repositioned with very strategic timing, right before those geopolitical headlines ever hit the wires.
And the really critical detail here, the thing you need to focus on, is the source of these funds. We can see it right in the on-chain data. It confirms that institutional-grade players, think Coinbase, Wintermute, Binance, they were the ones facilitating these massive Bitcoin transfers. And they did it just hours before the broader market reacted. What does that tell you? It tells us that these institutional actors were already de-risking their portfolios before the public even had a clue what the catalyst was.
You know, institutional updates like this move incredibly fast. Go ahead and subscribe and hit the bell. That's the best way to ensure you get this kind of research before the market has a chance to react.
Now, this sequence of events, it might feel random, but it's really not new. It actually fits into what we can define as a recurring market pattern. Here's how it works. A geopolitical negotiation gets kicked off, usually over a weekend to create maximum uncertainty. That, of course, triggers that initial volatility we all saw. But then, it's followed by a really strategic repositioning of assets once some kind of resolution is on the table later in the week. Understanding this framework, this pattern, is absolutely key to interpreting the capital flows.
All right, that brings us to point number two. Because this volatility we saw, it wasn't just driven by geopolitics. No, there was another crucial factor happening at the exact same time, a major development in the U.S. regulatory framework for digital assets.
So what are we talking about specifically? We're talking about the proposed Clarity Act. This was supposed to be the bill that established a clear regulatory path forward. Well, it failed to proceed. And the catalyst? It was the withdrawal of support from key industry players, most notably Coinbase. Their CEO came out, publicly stated his opposition, and that effectively killed the bill's momentum right then and there.
So you have to ask, why did they pull their support? What happened? Well, this right here illustrates the core conflict perfectly. On one hand, the bill's stated purpose was all about providing clarity. But buried inside was a disputed provision, one that could have put severe restrictions on DeFi protocols and the yield from stablecoins. For the foundational players in this space, that was an absolute non-starter.
And the market's reaction to this? It gives us an incredibly clear signal of where institutional confidence is actually going. Right after the bill failed, the queue for staking Ethereum, that's locking it up to secure the network, it hit a 2.5-year high. Just think about that. That demonstrates a massive capital allocation moving directly towards decentralized infrastructure, which is now seen as being free from those proposed regulatory chains.
Okay, so this brings us to our third major driver, and this is where we tie everything back to those initial geopolitical headlines. We're talking about the macro-level competition over strategic resources. So what was the underlying issue in those Greenland negotiations? It all comes down to access to rare earth minerals. These things are absolutely critical for, well, everything, from semiconductors to advanced defense systems. And as you can see, China currently controls something like 90% of the global supply. Now here's the kicker. Greenland holds one of the largest deposits outside of China. That makes it a pivotal geopolitical asset, and you better believe the market is starting to price in this resource competition.
Look, video analysis like this takes time to produce, but the market doesn't wait for anyone. For immediate updates on this kind of stuff, for breaking news the moment it happens, you want to join the Telegram news feed.
Okay, so let's tie this all together. The really crucial point here is how these two things, the regulatory drivers and the geopolitical drivers, are creating a very clear divergence in asset performance. Institutional capital isn't just moving in one big block. It's reallocating with incredible precision. And this chart, it illustrates that divergence perfectly. Look at what's happening. We're seeing these strong capital flows into physical commodities, your gold and silver, which are the classic safe havens during this kind of uncertainty. At the same time, you see flows going into digital infrastructure like Ethereum, which is that foundational layer for applications. But what about the digital commodity class, represented here by Bitcoin? Well, it's seen a short-term dip precisely because institutional capital is prioritizing these other two areas right now. So what are the key takeaways here for your own portfolio positioning? Well, first, it's clear the market is actively pricing in this geopolitical resource risk. Second, you have to understand that regulatory outcomes are creating very distinct winners and losers among the digital asset classes. And third, and this is probably the most important, it is now absolutely crucial to distinguish between digital commodity assets and digital infrastructure assets. They're being treated very, very differently by institutional markets.
So, all of this leads to the big forward-looking question, right? As this institutional capital continues to reallocate, which asset class is truly poised to capture the next major liquidity shift? Well, I analyzed a second infrastructure asset that's benefiting from this exact divergence, right here.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.